Ladies and gentlemen, Bitcoin saw that big drop downwards, right? Our yellow line, which you can see on the screen here, 5 years old, stemming backwards from 2019, ascending and then dividing the bear market from the bull market, from the bear market, from the bull market, broke to the downside. That was our sell point on Bitcoin. We got out of Bitcoin at around 54,000, right? And now we've actually found out over the days that have followed that we held that line for support on the daily candle and we're bouncing from that line. Now, a lot of people will look at that situation and they'll be like, oh, that's a sign to get back in. We need to buy the dip. Now, I want to clear up a lot of uncertainties here. People don't seem to understand the scale of what's happening right now, I don't think. They don't seem to understand the uncertainty, right? The crossroads that we're at here. Why did this drop happen? This drop did not happen because of anything related to Bitcoin. This was not a cryptocurrency drop, okay? This is a drop in global financial markets, okay? This drop was led by global financial markets, meaning that in order for a safe entry to show itself again, we need to be seeing global financial markets in a decent position once more, right? That's the simple bottom line. Global financial markets led to this drop. Global financial markets need to lead the way out of this drop. If they do not, the drop will continue, right? And the dip that people are telling you to buy will become a full-blown bear market. Simple as that. Now, here's the problem. No one knows what's going to happen with global financial markets. I'm going to look into it in this video. I'm going to show you the two separate cases that I see, right? One scenario I see is a full-on recession, right? A full-on downturn, a full-on depression, recession, whatever you want to call it. And the other scenario I see is the Federal Reserve stepping in and printing their way out of the problem like they did during COVID and completely destroying the dollar and completely destroying the debt even further to the point of probably non-repair, right? It's already basically there at this point. I mean, it's virtually there at this point from what I understand. Right, so there's two scenarios. There's a crossroads here. The market was led down by this drop in the traditional markets, this drop in global financial markets. And the only way the market's going to get in a good position again is if that is resolved, right? And the only way it can be resolved, in my view, is via hyperinflation, right? So, what are we talking about here? When we look at these support zones, we look at the support zone that's held. Do you think this line matters anymore? Right? This line matters. Yeah, cool. It's good for us to be able to react to. And perhaps if you're still in the market, you can use it as a sell point, and it will be interesting for TA purposes. And obviously TA is a reflection of FA. So it does still matter to an extent, but there's much bigger things at play here than lines, right? We're talking about the global economy, right? So we're going to look into the two scenarios. We're going to look into when you could safely buy back into the markets, right? What we need to see in order to ensure that this is not gambling, this is investing once more. Because right now, I'll tell you this, straight up before we even get into the video. If you are buying here, right, you are gambling. You are not investing. You are not trading. You are not buying the dip. You are gambling. The fact of the matter is, no one knows what happens next except for the Federal Reserve. That's the simple truth. Right, so let's look at a few things before we get into it, guys. Bitcoin, if you want to get 5,500 US dollars in rewards for signing up with my referral link, literally, that's all it is. Sign up with my referral link, $5,500 in rewards. It says it right there on the screen. I'm not making it up. You can do so. My referral link is down below. Click on that link, sign up to Bitcoin. It's exactly the same deal on BingX, except it's 4,000. Now, these rewards aren't guaranteed. There's a chance to win them, but what is guaranteed is a 15% trading fee discount on either exchange if you sign up with my link. They are both global non-KYC. There are no location restrictions. They are both very low in trading fees to begin with, even lower with my link, and they are both safe. They've never been hacked before, is what I'm saying. So they're very good exchanges. Use my links down below. I advertise them for a reason. Check them out. Let's get back into the content. Right, so let's look into Bitcoin first and foremost. Let's just get the TA out of the way. There is TA to be done, so let's look into it, right? 5-year ascending support line, which was our invalidation line for our Bitcoin bags, broke down to the downside. We sold at 54,000 upon the breakdown. Bitcoin continued downwards to around $49,000, where it found strong support at a 49K to 47K support zone. You can see there, the two red lines I've just circled are the support zone. It was a very clear support zone. After such a big drop, it was a massive drop on Bitcoin, a 30% drop, 29% drop in a matter of 7 days. Ethereum saw around 40%, nearly 40% in around 7 days. That support zone was likely to hold just because of what happened and the scale of drop in general. We also formed a new diagonal ascending support line here in white. So a couple of support lines forming, or a new one there in white forming, horizontal support zone holding from the ETF top. Okay, so we found support at 47 to 49K. That is the nearest support zone on Bitcoin. That's the level you should be watching for, holding the lows. We also have this descending broadening wedge structure, which is vaguely intact. I don't know how accurate this structure is. I look at this structure and I see a structure with a massive deviation / fake out. I'm not sure, again, I'm not sure how accurate it is. If we look at the top of the structure as well, there's realistically only 2 retests, if we're being clear. If we're being vague, you can say that all 4 of these wicks retested, or 5 of them, but at the end of the day, that's not really what happened. There's only really 2 retests on the top there, and the 3 retests at the bottom are intact. However, the most recent one was just a massive deviation. So I guess you could say this vaguely is a descending broadening wedge, but again, I'm not sure how confident I am in that structure. But for now, we'll just leave it on the screen because I suppose that's all I can see there. So you can see right now that Bitcoin had a deviation below that wedge. A wedge generally is a bullish thing. It generally is a thing you swing back to the upside and break to the upside. And with the massive liquidation, if that is the bottom at 47 to 49K, it's a very strong bottom. The TA right now doesn't look terrible. The things that look terrible on Bitcoin are the cyclical deviations we've seen, right? Lines that were previously very important becoming not so important anymore. So we look at things like, and again, we've done this many, many times. I'm just going to do it one more time for you here today because it's very necessary for you to understand this before we get into the traditional market TA. Things like the bull market support band, right? And things like the pi cycle center lines. These things, okay, these very, very important historical indicators have been just that, very, very important historically speaking. Let's just take bull market support band for an example. They've led to the bottom on every single major move to the upside of a 2017 bull market. We did not fail holding that line once in a 2-year period. Every bull market, every bear market, this line is here. It's very strong. There are deviations occasionally, but they're very rare and very few and far between. The problem with right now is what we've seen is a deviation, not only 1, but 2 deviations over the matter of a month, right? And and look, if we go upwards here, that will be a 3rd deviation, right? So there's no scenario here, really at all, that is good for Bitcoin cyclical TA, right? Because we look at this situation again, macro indicator, very, very important. It's not just this, by the way, this is just an example. 2 deviations in the matter of a month. And if we have bottomed here, that's the 3rd deviation. You pretty much look at that bull market support band from that point forward and just throw it in the bin, right? 3 deviations in a 2-month period. Mate, that's not typical at all of bull market support band. Just shows you how abnormal the price action has been. The price action's been abnormal ever since basically the start of June, really. I mean, if we bring up the SPX and we overlay it with the Bitcoin chart, let's flick to the daily chart quickly, overlay the SPX with the Bitcoin chart, you can see, let's go ahead and pin it to a new scale, 1 second. You can see the abnormalities start right here. We saw Bitcoin dropping downwards, the SPX continuing to the upside. That reverse correlation continued for about 2 months. It was not only a decorrelation, guys, it was a reverse correlation. The Bitcoin chart and the S&P chart pretty much always move together. It's been that way for over 4 years. And starting right here in June, upon the breakdown of the mid-range level, right? The upper range being right here, the lower range being here at 61K. This middle kind of circle was the mid-range level. Upon the breakdown of that mid-range level is when those deviations began, and the deviations lasted all the way until the peak we saw before the drop downwards. The peak we saw before the drop downwards was defined via a ascending wedge structure, which we spoke about in this YouTube channel. We predicted the breakdown of that wedge. We did not expect it to go this low, that's for sure, but we predicted a swing downwards to around 62K, potentially 61K. That occurred, however, it just didn't stop. So the abnormalities in this range, I mean, they really started back with ETFs, cyclically speaking, but in this range, the abnormalities started in early June, and we discussed this very extensively. That June breakdown, this breakdown right here, was not meant to happen, right? It wasn't meant to happen. If we were going to see a regular market structure, we would have broken upwards there in June. That's the simple truth, right? But for, an countless number of reasons that I could name and some that I couldn't name, we didn't break upwards, we went downwards, and we started this abnormal market structure. And from that point forward, our historical indicators stopped acting, as concrete as they once were historically speaking. This wasn't only actually 2 deviations. I mean, this was 3 deviations. This was completely ignoring it here in this weird consultative period, ignoring it here with a deviation, bouncing, ignoring it up here, and then coming back down. And if we go upwards, we ignore it again. This is a very strange Whatever we're seeing here is strange. And this is why we're looking away from Bitcoin and cryptocurrency for the cause of this. This is not Bitcoin and cryptocurrency related. What we're seeing here is not related to Bitcoin and cryptocurrency, okay? This is related to something bigger than Bitcoin and cryptocurrency. It's related to the global economy. It's related to geopolitics, right? This is why everyone I see right now who's looking at Bitcoin down and they're thinking, oh, we got to buy the dip. You don't know if this is a dip, right? People saying buy the dip in 2021 over here were wrong as well. Right, we saw a massive liquidation event there as well, with a massive wick to the downside that was eaten up by buys as well. Right, look at that wick. Right, we closed there on the weekly candle at 49k. We went all the way down to 42k on the weekly candle. That's very similar to what we're doing right now. We hovered in that region for a week. Right, within that week period, people would have been buying. They would have been saying it's a dip. They would have been saying we're swinging back to the upside. We found support in this region here. It wasn't a dip. We went downwards into a bear market. So when you're saying buy the dip, you're saying that. And you have to be saying that. The only way you can say that is saying it knowing that there are larger cyclical trends and structures that are still intact. Otherwise, it's not a dip. It's potentially the start of the bear market, right? The reason why this wasn't a dip right here is because the bull market was over as per the 4-year cycle. We had broken levels that were important to the maintenance of the cyclical structure. We were below those levels. Therefore, it was not a dip. Therefore, it was the start of a bear market. Now, right now, we are in the same situation. Not only are we below the major cyclical levels, the major cyclical levels have lost validity, meaning it's very hard to dissect what's actually going on. That's why I'm not saying this is a bear market per se. I'm saying this is an uncertain market environment and we need more clarity. Now let's look into, and same thing with Ethereum. Ethereum's on support, but it broke down from major support as well. The total 3 is in the same situation. Total 3 cryptocurrency market cap broke down from support, went downwards massively, but now, just like Bitcoin, somehow is maintaining the weekly chart RSI structure and somehow is maintaining the the horizontal high it found in green there that I'm highlighting, which it did on step 3 back here in that cycle. And so you could make an argument that's going to go upwards from here. But again, I don't think you have the macro clarity to make that kind of argument. So now we need to get into, look, we understand this is more than Bitcoin. We understand this is more than crypto. Now we need to get into what is it? What has happened here? And what are the two scenarios as we go forward? Before we do that, guys, check out the VIP group on Telegram. We trade altcoins 4 times a week. We have a group chat with 120 other members in there. You can discuss the market, post charts, share ideas with those members. But obviously, if you're getting in this group, the main thing you're there for is the signals. They're posted 4 times a week. They have a historical 78.39% win rate. You've got a PDF there with all of the historical trading results. It's a very strong track record. It's all transparent. Every single win, every single loss is on that PDF document. And again, you'll get that group chat access as well. We've just dropped the price down. It's actually 40 USD. It's down to 335 for a membership lasting until April next year, which is a very good value in comparison to other VIP competitors. This is extremely good value, especially given the transparency of the win rate. So get in there if you're interested. The links are down below. Let's get back into the Bitcoin video. Now, what are the 2 scenarios for the traditional markets? What do we know and what don't we know? What we do know is that the S&P is in a pretty dangerous position right now, which goes into what I was saying before about not necessarily viewing this as a dip. We need more evidence of upwards movement if we're going to say it's a dip. Right now, it's a crash shrouded in mystery, really. So S&P 500 broke down from something we identified many times, actually. In October 2023, formed the base for an ascending support line on the price chart and on the RSI. That's a basically 10-month-long support line on the RSI and the price chart. We broke both of those lines, right? We broke on the price chart and on the RSI. We broke bull market support band, speaking of that a lot this video, and we broke a horizontal support, which we found as a neckline from the previous 2 highs in March and also in May. So the S&P is in a bad position. It's not good to see a break from a neckline like that. The S&P generally moves in one direction only. You don't generally see big breakdowns of prior highs in the S&P. You just see how the S&P moves in 2020, straight upwards. Yes, that was quantitative easing, but even if we go back to periods before quantitative easing, you just see the S&P for months on end just solely grinding upwards without any major breakdown of prior highs. Does occur occasionally, but generally speaking, the S&P is very one directional. It moves upwards only, really. Upwards only unless there's a recession, in which case it will move downwards, but if it's not a recession, it moves upwards only. That's how this works. And right now we've seen a breakdown of 2 local highs as well as 2 angled trend lines as well as moving averages. So this is significant here for the S&P. And you might be inclined to say, oh, well, it's just a pullback. And look, you could be right. Here's the thing. You could be correct. But the problem is, it's not just the S&P. There's data coming in. There's unemployment data, right? So in the dark blue, we've got unemployment. In light blue, we've got the S&P 500. Unemployment always rounds out before it spikes to the upside. Every single time it rounds out and then it spikes to the upside. There's literally not a single occasion in the last 80 years of history. There is not a single occasion, all the recorded data, of unemployment rounding out and then not spiking to the upside. Every time it rounds out, it spikes to the upside, right? It's doing it right now again, meaning it's rounding out. Therefore, we are likely to see a spike to the upside. And most of the time, historically speaking, most of the time, not all the time, but most of the time, the spikes to the upside lead to recession in markets, okay? Right, 1950, spike to the upside, right? We didn't see a recession in markets. So let's just go ahead and tick and cross here. Right, let's actually do that. That's a good idea. Tick and cross every single time. Okay, we saw a decline in the markets here. It spiked to the upside. S&P went down. So that's a tick, right? This is a cross. That is a, we did see a drop in the markets. That's a tick, right? We didn't see a drop in the markets there. It's a cross right here. Tick, tick, right? That's a cross. Oh, well, I suppose there was a drop in the markets there on the second wave upwards. So that's a tick. Over here, we didn't see one, cross. Over here, we did see one, tick, tick. In COVID, we did see one. It was very brief, but we did see one. So what you see is that when unemployment spikes to the upside, we have occasions here. We have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 scenarios of unemployment significantly spiking to the upside. And out of those 11 scenarios, 8 of them have led to significant downwards price action on the S&P 500, right? Recession, essentially. Or if not recession, at least bear market. Depends on how you define your terms. It seems the government's changing the meaning of these terms every 3 days. So let's just say significant bear markets, 8 out of 11 times, and it seems to be happening again. So what is likely here? Well, the likely scenario, right, if we're looking at the historical data, is a significant downturn in markets, which makes this correction here in the S&P seem to be more than just a dip. But there is a spanner that's thrown in works. We'll discuss that in a second, but we need to make this case a little bit further. It's not just unemployment, right? It's the bond yields tanking. Bond yields tanked, as you can see right here, around July, before the FOMC meeting. Bond yields went downwards massively, like 20%, and the Federal Reserve decided to hold interest rates at the same rate. Now, the Federal Reserve has 400 PhD economists on team, right? They understand more than anyone that when bond yields tank, it means you need to cut rates, right? They did not cut rates. What does that mean? It means that there is a scenario here that they understood what was happening and decided to keep rates high in order to drag markets down intentionally, right? So that's interesting, right? And that could play into the recession scenario. Maybe they want to see a recession. It would be abnormal. It's not what people expect. People expect inflation, but maybe they want to see it. Another thing is the SAM rule recession indicator, right? SAM rule recession indicator. Now, what happens here is every time this number on this screen, let's just read out the text. SAM rule recession indicator signals the start of a recession when the 3-month moving average of the national unemployment rate rises by 0.50 percentage points or more relative to the 3-month moving averages of the past 12 months. Now, we have seen that rate right there, that percentage move above 0.50, which again, historically has been indicative of a recession beginning. Now, it can reverse back down, but it's unlikely. Right, so we've got traditional recession indicators triggering across the board. Unemployment, SAM high rule recession indicator, Federal Reserve not acting normally, not responding how they should respond to bonds, right? So there's actually a decent pool of data here saying we could be seeing a recession, in which case this is not a dip, this is a bear market. But here's the opposing point of view. Everyone has always kind of expected, since COVID especially, that the Federal Reserve will just print their way out of trouble, including myself. I mean, that was that's what I was leaning to, right? It seems as though the Federal Reserve is just pretty content with just creating more debt and printing their way out of problems. That is still a possibility, especially given that, yes, rate cuts were late, but they are deciding to cut rates. And look, we could be seeing a 50 basis point cut. There's a lot of speculation right now. People think we're going to be seeing an emergency rate cut as well. Now, if we see 50 basis points, I expect some sort of bullish market reaction from that, because that proves that the Federal Reserve is actually quite serious about bringing down rates and hence creating more debt. right? So we'll see what happens here. But the point is, we've got the inflation scenario, which is the traditional scenario that everyone understands. Everyone understands what quantitative easing is. It's where they print money, right? And all asset prices rise. That's the scenario that a lot of people were thinking was going to happen here and end off this cycle nicely for a massive pump. And now, unfortunately, the spanner in the works has been, we've got all these kind of recession indicators triggering, S&P 500 is breaking down, and Bitcoin's getting dragged down with it. So the whole market is getting dragged into this pool of uncertainty. We do not know what happens next. Do we see recession or do we see more printing? We do not know. We simply do not have the conclusive evidence. Like, you can speculate all you want, but if you don't have conclusive evidence, if you understand that the drop has been caused by traditional markets and you don't know where traditional markets are going, any buying you do on Bitcoin and cryptocurrency is hence gambling. It's very, very straightforward, guys. Now, with all of this said, like, there are levels that Bitcoin needs to get back above. Don't get me wrong. And if it does get back above them, that's great. You know, for example, 60K is a level. For example, on Ethereum, just getting back above its range support, but it lost its level, or breaking the descending line. These are all levels we need to get back above. You know, the weekly chart on Bitcoin, we need to break the weekly chart RSI and flip momentum back to the upside. That will mark a momentum flip that we haven't seen since March, which is the all-time high. All of these things would be good. But again, you know, they haven't happened yet. And so all the price action that's occurred here has basically been meaningless. Like, yeah, okay, we've maintained the structures. We've formed new structures and maintained old ones. But what about the cyclical structures, right, that we just broke down and invalidated and thrown out the window? What about those ones, right? Why don't we look at those? Because those ones are more important. And for me personally, I don't see holding support after a 30% move to the downside to be much of an accomplishment. But you're going to hold support eventually. It's not really an achievement to me. I need to be seeing actual breakouts to the upside. And for me, that will be evidence. That will be an achievement of some sort. That will be evidence that Bitcoin is regaining strength. And I also need to see that on the S&P 500 as well. So let's be very clear. I'm not saying that we can't go upwards. I actually don't know. I genuinely do not know. And I think we need more people to come out and say that. Because a lot of people have very strong opinions. And let me tell you this right now. They say it for sensationalism. They say it for views and clicks. Because at the end of the day, if they're wrong in their opinions, people are going to come watch them anyway, right? Everyone's going to forget after 2 months, and they'll still watch them, and they'll still use their referral links. They'll still click their advertisements and watch their advertisements for their YouTube videos. They're still going to make money. It doesn't really matter if they're right or wrong. And for me, I'm not interested in playing those games. I'm sitting here confidently and saying, I don't know. I need more data. When I get that data, I'll bring it right to you straight away. So be sure to subscribe. Leave a like if you appreciate it, and comment. I apologize for the uncertainty. It's not my fault, I guess, so I shouldn't be apologizing, but I suppose, you know, if I wanted to sit here and share every little detail about what I think is more likely and what I think is less likely, I could do that, but I actually ultimately think it won't help you. I think part of being a YouTuber as well, you know, you be honest where you can, but at the same time, if there's periods of time where your opinions are, you know, how do I say this? If your opinions are weak opinions, they're opinions that can shift on a dime. I sometimes think they're not worth sharing. Like, what's the point? Like, it's just going to confuse people. It's just going to make people do things that they could regret like, I have to be very careful with what opinions I have that I share. I have to be very confident in them. And I don't see reason to be confident in any particular bias right now. Hence, I'm choosing not to share any opinion. I'm just showing you the data, showing you what I see, and showing you what we need to see in order for me to form a confident opinion, right? Hope that makes sense, guys. But thanks for watching. Again, check out the exchanges, BitUnix and BingX. We've got the sign-up fees, sign-up rewards, I should say, $5,500 for signing up on BitUnix. The link is right there. You can see it. It's in the description below, but you can see there right on the screen, $5,500 for signing up with my referral link. Also guaranteed a 15% trading fee discount with either exchange, BingX or BitUnix. Guaranteed 15% trading fee discount. The reward is a little bonus. If you get it, you get it. If you don't, you don't. But these are global non-KYC exchanges. They've never been hacked before. They're very low in trading fees. And again, you'll get it even cheaper with my 15% trading fee discount. Check them out. Also check out the VIP group, right? We've got 4 trading signals a week. We've got a group chat. If you want to trade altcoins, that's where you can do it. Fully transparent results there. It's all in a PDF format, 78.39% win rate. Check it out if you're interested in trading altcoins with me. And then finally, the Crypto Academy's Become a Trader 10-unit course is on sale. And you want to learn how to trade, this is where you can do it. Education, premium education, if I will say. on this website, right? You can read up about it on the website and click on the email link, which is on the website. Throw us an email, ask us any questions. We'll get back to you within 24 hours. Check it out. Guys, thanks for watching. Hope you enjoyed. I'll catch you tomorrow.